Welcome, welcome everyone to our accounting webinar today. I'll just give it a few minutes before everyone joins. But it's great to see you guys taking out your lunchtime to learn a few things. In the meantime, until we do wait for everyone to come, I'm just going to start a poll, and if you guys could just answer that, we can see the different answers. There we go. Awesome. So just 2 more minutes. Let's get the poll up, see what the answers are so far. Okay, no one's answered it yet. That's okay.
And maybe comment in the chat who you are, what your business name is, and which city you're dialing in from. It'd be really interesting to see, to introduce yourself and see whereabouts where you're located. We've got a technology company, sales and marketing, efficiency.
Good range. We got some accountants.
Excellent. Yeah, there seems to be a big theme on efficiency, with everything getting more expensive, and you know, it's more important than ever to have things streamlined and processes bedded down. So we can see why that's a pretty important area to be focusing on. We've got some sales and marketing, some financial growth, customer experience is critical, technology is critical.
Mm-hmm. Awesome, really good range of people here. Okay, I might just give it a few more minutes.
Great, we've got a few on the legal advice plans as well, which is great. You've probably been speaking to Damon and the team, which do a fantastic job advising business owners of their legal obligations and helping them on those topics throughout the year. So that's great to see you guys coming on, and I'm sure you're getting a lot of value out of that service. Interesting spread with the how old is your business. So we've got some new businesses, which is great. We've got some older businesses as well, and I think some of these mistakes you might have come across and dealt with before, but it's always good to get a refresher, and maybe there'll be some tips in here that will sort of just help you refocus and prioritize some things that you should be focusing on for your business for the second half of the calendar year.
Okay. Go for it, Pat.
Yeah, and biggest challenge. Interesting, starting a business, hiring's definitely been really challenging in this current environment. Cash flow management, we've got some tips in here for cash flow, so hopefully they help. It's always a big one, managing your cash flow. Setting up the structure, really important. Time management, we've had a pretty even spread across these, so it looks like people are having different challenges, which is expected, and different industries and people trying to do different things.
Great to see that COVID-19 hasn't really affected anyone, which is positive. Okay, awesome. Cool. I'll begin, guys, and then we'll just wait for anyone else, whoever wants to come, they can join. So welcome to today's webinar. My name is Angela, and I'll just go through some housekeeping tips before we begin. So if you guys did want to ask any questions during the webinar, please feel free to add it to the Q&A box at the bottom, not through the chat, because as you guys can see, a lot of people have given answers, and we don't want your questions to, you know, hide, and we want to get through as many as we can. So if you have any questions during the webinar, feel free to add that, and then we'll answer it at the end. So today's agenda, just a quick overview about Lawpath and Patrick from Pop Business. We're going to go through the top accounting mistakes businesses make, the impact of these accounting mistakes on your business, and how to use accounting tips to safeguard your business. And as I mentioned, we've got a Q&A at the end and a very special offer for all the attendees today. So Pat, do you want to go to the next slide? So for those who have already been to our webinars before, you would know a little bit about Lawpath, but for those who are joining us for the first time, welcome. I'll just give you a brief overview about Lawpath. So essentially Lawpath is your all-in-one business hub where you can access multiple tools to help your business. It's designed to provide tools that you need from a legal side of things, plus accounting. So we've got over 350 plus legal documents, covering areas such as employment, intellectual property, business contracts, website compliance, and much more. You can sign documents online using our e-signature tool. You can also hire a lawyer through our lawyer marketplace, as Pat mentioned before. We've got on-demand calls of our lawyers and accountants to discuss your legal needs. And you can also register a company, ABN, or a business name. We just move on. So our wonderful host today is Pat. He is the CEO and co-founder of Pop Tax and Pop Business. So Pat is a chartered accountant and a registered tax agent. And he's got expertise in business advisory, tax compliance, and virtual CFO. And Pop Business is Lawpath's preferred accounting partner, and they do an amazing job. And we've been lucky enough today for Pat to join us to give you guys all the advice that you may need in terms of your accounting, especially with the end of financial year coming up very, very soon. So I'll pass it over to Pat so he can start the webinar. And yeah, so if you guys have any questions, feel free to just pop it in the Q&A. Go for it, Pat.
Awesome. Thanks so much for the warm introduction. And there's going to be a few tips in here that if you've been in business, you're definitely going to be across them and you've probably dealt with them. Hopefully there's a few new ones that you find really valuable. And yeah, as Angela said, if you've got any questions, feel free to put them in the FAQ, and at the end of the webinar, I'll go through as many of those as possible and try and give as much advice on the questions that get asked. So this is the most common one, and it's quite an obvious one. It's no separation of business and personal expenses. Really simple one to start with, but it just happens so often. So often we have clients and using their business bank accounts for personal expenses, and there's just lots of errors within the accounts. You've got to think, if you've got a few transactions a day, you've got thousands of transactions for the year. So it makes it a lot more difficult to pick up on misallocations. So there's higher chances of errors. You could potentially have overstated expenses and income. It's also longer, so it takes a longer time to reconcile the accounts, which can be timely and costly. And it's really hard to get an understanding of your business's position and performance when you have all your personal and business expenses mixed together. So this is just for any new business owners. Just when you start out, it's really critical that you get your business bank account, you separate your personal expenses, and you pay yourself from the company, which we'll get to in a bit. But making sure that if you have those personal expenses, if they're not in relation to your business, just keeping them separate, going through a separate account, and not having them mixed up in your business transactions, because it's definitely going to cause some headaches and issues down the track. We'll talk about some common business structures. So we've got a sole trader, which is where you've got a personal ABN. We kind of recommend this structure for people who want to do their business as a sort of side hobby, or if they're a contractor and there's not much risk in their business. They might have some personal services income where they're sort of just basically just selling some time to some companies. It's a higher risk structure. There's more liability issues with it. If you get sued, your personal assets are at risk. It's also not great from a tax effectiveness perspective. So there's not much opportunities to look to minimize your tax. And from a tax planning perspective, you're a bit limited. Whereas if you had a corporate group structure and a family trust, you got some opportunities to do some income splitting, utilize dividends, franking credits, and look at ways to utilize the company tax rate, which is capped at 25% as opposed to the personal tax rates that go up to 47%. Partnership, it's not a bad structure if you are setting up a business with someone else, and you know, if you don't know each other too well, you want to have a contract in place for the profit share of the business. But we don't really recommend that. It's again, it's got more liability. The partners are held accountable for the other partners, so you could be at risk if your other partner goes rogue and does something wrong. So it's got a bit of risk within that structure. There's ways to create a different structure like a company and have different agreements that, you know, make sure you guys get income split as you want it to, so you can get the same outcomes whilst having, you know, a different structure in place. The company structure, that's sort of a pretty common structure for businesses, and a pretty good structure if you're looking to grow your business, potentially sell some shares, if you want to raise some capital, if you want to cap your tax at the 25% if you're a trading company. That's usually a great structure, and you can also have multiple companies that further protect your assets, and you know, if you've got different verticals within your business, it's good to have a company where you can have those verticals separated if there's an opportunity to scale up and sell one of those verticals. And you can always do a consolidated financial statements and tax return if you needed to see what the overall group's position is. Trusts, if you're a trading business, we probably wouldn't recommend a trust. Trusts are great for personal shareholding. So a family trust is a great way to hold your shares in your business. And look, it can be beneficial to sort of trade your business through a trust, but in general, a company's most likely the best way. And a corporate group is if you've got a bit of complexity within your structure, and a corporate group's a good way to set up your structure. So there's a few different types of structures and ways to operate your business through. They've all got pros and cons, and I think it just comes down to like where you're at with your journey, how serious you are about taking it, how big you think it's going to get, how quick you think it's going to grow, how much risk your personal assets might have, and what some ways to minimize those risks. A really common structure, which is if you want to sort of grow your business a little bit, is to have the family trust holding the shares in the holding company, and then the holding company holding shares in a trading company. And then the trading company is your sort of business that it's got your income and expenses going through. Your holding company's holding your cash and your IP and all your intellectual property and contracts, etc. And this is a great sort of structure if you're growing your business. The two companies it's referred to as a dual company structure, and it provides a good layer of asset protection, and then good from a sort of tax minimization perspective. It is a bit more expensive to set up. As you can see, there's two companies and a trust. So you might ask, at what point do I look into this structure? And it really comes down to where you're at in your business journey. If you started as a sole trader, we'd look at sort of your trading activity, how much sales you have, how much profits there. If you wanted to have a holding company, we'd normally say, do you have sort of 200K in cash within your business? And if you do, then you really want to protect that cash. And a family trust, again, great way to hold the shares. And at the end of the year, you can work out whether you want to pay dividends and income split for some of the profits from the company. And you'd usually have a sort of bucket company underneath the family trust that could send some income over there as well. I think the sort of moral of all this is just to make sure you get a bit of advice about your structure. And obviously, you don't want to spend too much money up front, but you also want to make sure that you set it up correctly at the right time, because changing the structure can be costly. And if you wanted to change the structure in the future and bring in a family trust, if you've got the shares held personally, there could be capital gains tax implications on changing the structure if the business has some activity. So it's really important to engage with your accountant and or advisor on a regular basis, just so you are making the right decision. It's always better to set the structure up a little bit sooner rather than later, given the costs and the tax consequences via doing it later. But it's also important to manage your cash flow and not pay for things too early, because there is potential, additional expenses to maintain companies, and there might be additional reporting obligations. So as I said, there's some considerations and questions to help you find the right structure. A key one is, do you have any personal assets, and what would happen if something goes wrong? Are you looking to hire employees or contractors? If so, then you should definitely not be a sole trader. How much income and cash will be within the business? That could help with working out the holding company, whether you want to put a holding company in there. Will there be different verticals within the business? So you're going to have different types of income coming into the business. That will help determine whether a corporate group is a good option. And again, you'd weigh up the cost to set it up and the ongoing costs versus what you're trying to achieve by having that. Do you have any family members to split income with? Again, does a family trust work for you? How much profit is there? And at what point do I change my business structure? We see it all the time, people trying to change it later when they've got a lot of net asset value and there's big tax implications, and the cost to provide the advice for the restructure is quite significant. So it's a bit of a balancing act as to when you do it. The key point is it's important to get advice up front. So if you're unsure, please reach out. And even if you're structured in a particular way now and you're not sure if it's operating the best it could, definitely do a bit of a health check and touch base and get some advice with an advisor to see if it's structured in the most optimal way. Another mistake we see really commonly is clients not having employment contracts for their employees. It's really common. We've got a lot of construction tradie clients. We've got clients in all different types of industries, and they just bring employees on without really doing the correct paperwork and the due diligence. So an employment contract is really necessary. It protects the business and the employee. Not reviewing the award wages. We see that a lot. Sometimes if they're working away, they're entitled to certain allowances. So it's important that they're across these things. The TFN declaration needs to get done when you bring on a new employee. We see that getting missed if we aren't involved in the setup of a new employee. The lodgement due dates. So you will need to, if you have an employee, you pay your withholding tax on a monthly or quarterly basis. Usually it's monthly if it exceeds 25,000 for the year. If it's quarterly, it'll be through the business activity statement. Single touch payroll, so lodging the wages late, you have 7 days to submit the wages to the ATO. So it's important that you're up to date with your payroll, using it through an accounting software, and you're remembering to file the single touch payroll. So that will start becoming a bigger thing in the future regarding, whether there's going to be penalties and stuff for not lodging. Superannuation clearinghouse, making sure that you understand the superannuation obligations for your employees and you use a clearinghouse. We see people trying to pay direct for multiple employees. You have to go through a clearinghouse now, where you pay once to the clearinghouse and they disperse superannuation to each of the employees' accounts. Superannuation and wages. This is an important one. It's deductible once it's paid versus reported. So if you we're coming up to the end of the financial year, if you wanted to top up your super as a way to save some tax, it's a great tax minimization savings tool. If you've got some profit in the business, or you got some salary from the business, and you got some spare cash that you're not using within the business, you could top up your super to save some tax. The key with this is it's only deductible once it hits the superannuations account. So you need to allow a few days to transfer the funds and for them to recognize those funds. And if it's a personal contribution, just make sure you do the notice of intent to claim form so that you can deduct that. If it's from the company, you don't need to do the notice of intent form. And there's a new stapled fund requirement. And what it does is it's stopping people having so many superannuation accounts. What was happening before was people would change jobs and then have a new superannuation account with each job they started. And so this is making employers jump in and search that if they have an active staple fund, and if so, to send the super there. And this stops employees having multiple funds and getting charged, advisor fees and lots of different insurances and things on multiple small balances. So this is a good step in the right direction. But it's important as an employer that you understand that you need to do this when you're onboarding an employee and you're not just, it used to be you can just select the default fund. Now you have to check if they've got a superannuation account available. This is a big one, no logbook. We see a lot of business owners, they're a bit blasé about their motor vehicle sort of reporting requirements. And it's really important that you do a logbook. So you need to do it for 12 consecutive weeks. Once it's done, it's good for 5 years. And within each journey, you need to put the start and end date of the journey, the odometer readings at the start and the end, and the kilometers traveled, and the reason for the trip. So why are you doing this business trip? You only put in the business trips, and at the end, you'll get a total business kilometers traveled, and then the opening and closing odometer, and we'll get a business percentage. And all we're trying to do for this period by having the logbook is get a really high business percent that we can apply against all the motor vehicle expenses, including the depreciation and the asset write-off. So this percentage will determine how much motor vehicle expenses you'll claim. So if you've got 10,000 for the year in motor vehicle expenses and your logbook is 60% business use, you'll get the $6,000 deduction. So what you'd want to do, you want to have the 12 consecutive weeks when you're doing less private travel. It's purely on the percent, so it's not on how much travel was done. And what that means is the percent isn't, I traveled 1,000 business kilometers for this period versus 300, so that's a better period to use. It's about the private use as well. So we're really just trying to work out how much business use versus private use as opposed to the total kilometers traveled. If you've got 2 or more cars, you need to use the same period. So you can't have one doing it for different periods. You need to use the same 12-week period for all the business cars within your business. If you just buy a brand new vehicle, an exception to the rule might be that. But if you are using the logbook in the current year and you have a couple of motor vehicles, you should use the same 12-week period. Another one we get a lot of errors with is multiple entities using the same accounting software and bank accounts. And that's basically where there's different companies within a corporate group and they just use one bank account to do expenses for another company and even get income payments in there and pay expenses on behalf of another company. It happens a lot and it just creates a lot of time and complexity. It increases the manual journals required. Sometimes it has to happen a particular way and that's fine, but it's really important that if you do have a separate entity, you don't have a MYOB or Xero file trying to run 3 different companies through the one file, because we do see it. And it's really important that you separate your entities into their own files. And it's really important that you have separate bank accounts so that you can track the transactions for each entity. We are required to have the financial statements for each entity. And within the tax return, the business tax returns, we do need to put in things like the assets and the liabilities. and the loans and shareholder loans and things like that. So to get to that point, we need financial statements, and it just creates a lot of time and complexity if we are doing a lot of different things through the same account that shouldn't happen. GST is a big one. So for GST, most of the people within this webinar are not within their first year of business, but if you are, you'll note that you need to register for GST if your sales exceed 75K. It's probably good if you are, not within your first year of business or you've been trading a bit. Just review your cash first accruals registration with the ATO. It's important to make sure that you're set up correctly. As an example, if you on cash basis, you report your GST when the cash is received into your business and paid out of your business for eligible expenses and income. And from an accrual basis, it's on the invoice date versus the actual transaction bank date. How that works in practice is, an example here is if you issued an invoice to a customer on the 30th of March and there was $5,000 in GST, the customer might pay this 30 July, they'll pay it at a later date. However, we'll need to report and pay the GST in the March quarterly BAS, even though the 5K is not yet received. So on this example, if we've got high sales invoices and we don't have many purchase invoices to put through, we're going to be out of pocket some cash and potentially for a few months. And if your business is growing, or if your cash is tight, it's really important you get this right, because it can get a lot worse once your business grows, and you can be out of pocket a lot of cash when you could easily just have it on cash basis and just report when the cash is received. On the contrary to this, if you have big purchase invoices or you're building up your inventory in your business, you could, or if you get good terms with suppliers and you don't need to pay for 60 to 90 days as an example, then it could be good to be on an accrual basis, because you might get GST refunds before you even pay the money, which is the contra to this example. And it's important to discuss your GST requirements with your accountant, just to make sure that you're set up correctly and you're managing your cash flow optimally. And the LAAP calls can certainly assist with this. Another one is accounting systems not set up correctly. This is really common. Some business owners try and run their business through Excel and it's a mess. Some clients don't like linking their business bank accounts to accounting software. Some clients link personal bank accounts to the accounting software. We had a client the other day come through and they had like 14 credit cards and personal bank accounts within their accounting software and wanted us to reconcile it. We were just like, it was like 90% personal, thousands of transactions, which was just completely unnecessary. So really important to split out your business and your personal bank accounts. Chart of accounts not reflective of business activities. So just making sure that your accounts match to the business activities so that you can read your financial statements. An example of that might be you've got inventory and you haven't set up your cost of goods sold. And you're not tracking your closing stock correctly, and you don't really know the profitability on your products, right? So having your chart of accounts reflective of what's actually happening within your business will help you to identify areas for improvement, and you'll be able to use your financial statements to make some strategic decisions. No bank rules created. So the accounting software these days is really fantastic. You can automate a lot of your bank rules and streamline your bank reconciliations. So we see clients not really utilizing that. Another one is no accounts payable process. So not saving purchase invoices against the bank transactions. There's really good third-party softwares you can use and link to your accounting software. Most accounting softwares have their own too, and that's just, you can take a photo of a receipt or a purchase invoice, or you can just directly email it into the software, and then when you reconcile it, saves it against the transaction. The next layer to that is the payment side of things. So making sure for your accounts payable that you're scheduling your payments on the due date, which I'll touch on in a little bit. Employees not set up correctly, so we see that quite a lot. Software not linked to the ATO. So your accounting software does link to the ATO. You can do lodgements direct from the accounting software to the ATO. And it just helps streamline things, and it even shows what's outstanding. And third-party software is not linked. That's another one where clients might have inventory and the inventory management software is not linked up, or they might have could be external payroll software and they're double handling things. So just making sure that if you are using any third-party software that does link to your accounting software, making sure it's linked correctly to make sure your reporting's accurate, and you're not double handling things to get your accounts up to date. So cash flows, the cash flow is key to growing your business, and with the advent of a lot of technology, there's a lot of payment options, and offering a diverse range of payment options definitely helps you get paid faster. Some people prefer card payments, so making sure that if you issue an invoice, you have your payment gateways connected within the invoice. You'll definitely get paid much quicker. We see clients pay purchase invoices and taxes in advance before they even need to, so it's important that you're scheduling in your purchase invoice payments on the due date. Sometimes you might not see, but you might have a 30-day or 60-day term, and if you're paying it in advance, you might be definitely it could be really detrimental. And that's why having a really solid accounts payable process in place will help you. It will definitely assist with your cash flow. We see a lot of clients just using their bank account to manage cash flow. There's definitely a lot of issues with this, but I think some simple solutions is definitely see if you can get a simple cash flow prepared and forecast out upcoming expenses, and within your cash flow, just make sure you have your tax expenses and your superannuation, your withholding tax, and a bit aside for income tax. There's some different methods you could do. You could have separate bank accounts you could have a GST account and an income tax account, and be putting some percentage of sales into these accounts and an operational account. That's totally fine to do that as a way to help, instead of just looking at a single bank account and not really understanding what you can and can't do with the cash that's sitting in that bank account. By far the best thing to do is a cash flow forecast, just so you can really plan out what's upcoming, and it'll really help with just looking for areas of improvement and assisting with your capital allocation. So where you should be putting funds. It will also assist with hiring, and if you've got inventory, or if you've got capital expenditure coming up, it will really help with that, and it will really help with the funding of those, which we'll go into in a sec. And a few more things is no review of the percentage of the expenses against the revenue. So the ATO's got publicly released benchmarks. So if you are in a particular industry, you can easily jump in and see what the benchmark data looks like against your business, and see how you're positioned on average. And that might be looking at things like labor, rent, capital expenditure, and things like that. So it's really important to just have an idea around what percentage of this expense should be allocated to your revenue. It will help with your pricing as well. So once you get a really good picture of what percentage of sales and marketing should be against revenue, there's different methods for that. Are you scaling? Are you growing? Are you just slowly increasing? But there are some really good rules of thumb that will provide good guidance as to how much you should be spending at those key account levels. And using the benchmark data will definitely help as well. Not enough planning when making decisions on hiring and inventory expenditure. Again, a simple cash flow forecast will definitely help with that. Funding options not explored and incorrect funding options utilized. So you might be looking at purchasing a motor vehicle prior to 30 June. They've got the temporary asset write-off, so you can write off the full cost of the vehicle, which is great. So you might be thinking about, I've got a bit of cash in the bank, I've got 30K in the bank, I'll buy this car for 20K. It might be better to finance that vehicle given the interest rate won't be too expensive, and there'll be a balloon payout at the end, and you might even want to trade it in and get a new vehicle in say 4 or 5 years time. You might be able to write off the full cost of the vehicle whilst you've only made one repayment against the loan for the year. So you might get the GST credits and the vehicle write-off, so you'll be able to expense the full cost of the vehicle, but you haven't actually paid for the vehicle yet. And so funding options is a good way to, you definitely need to explore those, and having a simple cash flow forecast or a good understanding of your cash balances will help you with your funding options. And we see this all the time, not enough consideration of the income taxes. So Australia's tax system is pretty high, like it does go up quite high for individuals, companies capped at 25%. But we do see quite often that business owners don't keep any cash aside for the income tax, and they get to the end of the year and they're not really set up in a position to pay that income tax. You don't have to have the whole amount sitting in an account, but it's good to have a plan in place where you've planned out that you will have enough cash to pay that on the due date, so you don't get any interest and late payment interest when you finally get around to paying that. Withdrawing funds, we've had a strategy. So we've got the legal and accounting advice plan, and James from POP does a fantastic job answering lots of questions. One of the key questions is this: so what cash should I withdraw from the company? And we get it quite a lot, and it's not a black and white answer. It definitely depends on people's personal situation and the business. How is the business tracking? What's the objectives as well? Are they trying to go get a personal bank loan? Like where are they currently at? There is definitely some things we can do from a tax effectiveness point of view. The key mistake we make is people just withdraw funds without really proper planning, and it can create Division 7A where they're just withdrawing the funds without any wages declared, and it's creating a loan. That can be a good strategy to use, by the way, but without a proper plan, it could be also really detrimental. You need a loan agreement drawn up. You need a few things in place for that to be in effect. And it can have some adverse tax outcomes. Wages not reported on an ongoing basis, so no tax withheld. So again, this comes back to the income tax side of things. If you're paying yourself on an ongoing basis and you're clearing some of the profit out to yourself as a wage and you're paying the tax as you go, you're not going to get that nasty surprise when you lodge your tax returns and have this lump sum tax payment owing it that you haven't accounted for. And a key one that just people don't think about is not enough cash in the company for operational expenditure. So they withdraw money, they decide on an amount they're going to pay themselves each month, and they haven't really put enough consideration into how much they should leave in the business. And that can be from a tax perspective, and that can also be from an operational perspective. And as a sort of rule of thumb, we usually want to see 3 months of expenses sitting in your bank account. That sort of protects you in times of a downturn. We've seen it during COVID-19. It happens. You might lose a key contract. You might lose a key staff member that you lose a contract because you can't fulfill it. It's always really important to have that buffer sitting there just to allow you to keep operating in case of an adverse sort of outcome within the market or within your business. Some tips to avoid this is speak to your accountant about a regular amount. So once your advisor discusses where you're positioned, what you're trying to achieve, where you're heading, what your history looks like, we always look back and have a look at what happened in the past. That will allow your accountant and advisor to set forth a regular amount to pay yourself, which will then help with tax effectiveness. It will also help with your cash flow forecast as well, so you'll be able to properly forecast what to pay yourself. Definitely, if there is profit in the business and you don't have other income in your personal name, pay a wage and withhold taxes on a regular basis. depending on your situation. So it could be that this company is a side hustle and you're earning a salary somewhere of 100K, and then your company's got 10K profit. Of course, we'll say keep the profit in the company versus paying yourself a wage. So it does depend on your personal circumstance. Everyone's different. If your company is your sole income, then it's most like, and it's in a profit, it's most likely going to be, good to pay a wage. The reason being is you're paying the tax as you go, and then you've just got a better understanding of what cash is left in your bank and what cash you can utilize in your company. So I mentioned the rule of thumb with the 3 months of expenses. Some have a bit more. Definitely wouldn't say too much less than that. So whatever your expenses are on a monthly basis, just make sure you've got a bit of a buffer. When we do the tax planning with clients, we look into the family group, and we look into how much wages we should declare at the end of the year. So if we want to declare a director's fee as an example, what does that look like? Do we want to do a dividend? Do we want to do some Division 7A? Is there a family trust and we can do some income splitting with some dividends? Is there a bucket company? So how much you pay yourself also depends upon your sort of personal group structure. And is income splitting available? Do you have a family trust? So these things really, what we do for our clients is an annual taxation planning meeting that allows us to sit down with our clients, discuss their objectives, look at the entities within their group. Do they have a company? Do they have a family trust? Do they have a bucket company? Do they have multiple companies? Do they have kids? There's been some recent changes around distributing to kids. So it's really important to do this planning meeting each year, and you'll definitely get some tax savings and some real tangible cash savings out of doing this. And it'll give you a good understanding of what to do for next year as well, providing that your business doesn't drastically change. And then speaking to your accountant on a regular basis will allow you to adjust your strategy in case there's significant changes within your business. And the last mistake that we see quite regularly, accounts not live and no regular reviews. So this is probably the most common mistake we see, and it's just sort of a lack of process, and business owners get busy and we get it, but just not having your accounts up to date really affects your business's position and performance, because you can't make those key strategic decisions. Your capital allocation will really depend how successful your business is. So your activities you're doing on a regular basis, where you're putting your time and where you're putting your cash. So those things are really critical. And if your accounts aren't up to date, you're definitely going to be at a disadvantage, and you're going to make poorer decisions. You can't utilize financial data to make the decisions and rely on actuals to work out what's happening and where you're going and what sort of decisions you need to take. And another key one is regular meetings. So making sure that you're having those regular meetings with your accountant and advisor, and that will put you in a really good position. So we definitely find that clients who don't speak to us, and their accounts aren't up to date, they're lodging stuff late, the business is not going well. We clients that we speak to regularly, we can advise on, they take on our advice. We see the financial data, it's live, up to date. They can make real-time decisions that will put them in the right direction. They're 100% performing better than those other clients. So definitely speak to an advisor on a regular basis and get those bits of advice that will put you way ahead of the competition. And a few more points. Just planning's key to success. And as I said, without the regular catch-ups, or without even yourself, without setting that regular review for yourself to put some importance on your business's financial position and performance, yeah, you won't really know what metrics to track, what your goals should be, where your business is heading. So it's really important that at the least you set up a sort of monthly review of how things are going, just so you can keep the finger on the pulse and make sure you're really on top of your business. We can't help if your stuff's not up to date because it's really hard because we might give the wrong advice based on incorrect data. So you really need your accounts up to date to get the most out of third-party advice. So if people are looking at reconciled accounts, you'll definitely get much better advice than if you're just feeding information to someone based on what you think, which may or may not be correct. It's definitely could waste some time, waste some money, and put you in a worse position. Another reason to have your accounts up to date is you won't be able to set up auto reminders for your invoices. So you might have clients receiving automatic reminders if you don't have your accounts up to date for something they've paid, which is a customer's pet hate. You might double up on payments, and you definitely will lodge stuff late, and you may get penalties and interest. You also may not be across your superannuation payments. So it's just really critical to make sure you are keeping things up to date. You're setting up regular reviews for yourself, which a lot of people don't. They just get sort of drowned out in the day-to-day activities and don't think strategically about their business. And then using the financial data to get the right advice on an ongoing basis, we find is definitely by far the best way to push your business forward. Cool. So we'll get to the questions in a sec. Really keen to jump onto the FAQ and see what you guys have got. I'll just introduce, we do have a legal and accounting advice plan. This is a really great product. So I've seen a few members are already on the legal advice plan. So you'd be getting really great regular advice. We've joined Lawpath and we offer this accounting and legal advice plan. So you get on-demand access to expert lawyers and accountants. And I think one of the key takeouts is, you really should be getting advice on a regular basis. You're definitely going to be in a better position. All those questions you need answers to, you can get access to an expert who will give you the best advice without you having to try and find things yourself and work things out, which may not be correct. So we deal with thousands of businesses in all different types of industries. So we're really well versed at providing that expert advice. And the feedback from the customers using and clients using this product is really great, and they find it really valuable. We've got a deal for you guys. So obviously, thanks for joining the webinar, and hope you got a bit out of it. We've got an exclusive offer, which is sign up today and get a 3-month trial of the legal and accounting advice plan for $199. So if you're interested in just trialing out this product, no lock-in contract, get some advice and see what you think of it. Comment yes in the chat, and one of Lawpath's team will get in touch and discuss this with you and how it works. You'll definitely get a lot of value. You'll definitely, recoup the $199 a month for the 3 months. And yeah, we definitely recommend this. All the feedback is really strong. We give really solid advice. And as I mentioned, like business owners that engage with us on a regular basis get much better outcomes. So for $199 a month, it's great value. And yeah, would love to speak, would love for you guys to just give it a trial and see what you think, because I'm sure you'll get a ton of value out of it. Cool. I'll let Angela jump in.
Thank you, Pat. I hope everyone enjoyed that presentation. So we do have a few questions that have come through. So Pat, I'll read it to you and then you can go ahead and answer them. So the first question is, as a GST registered company, if I trade with the European Union, do I need to pay GST or VAT on the online training services I provide to European clients?
So my understanding is if you have a sale to a company that's internationally, it's usually GST free. So it depends where your business is registered. So if it may be a requirement to register an entity in the UK. So this is obviously an international tax question. So I definitely recommend um, getting some advice on that. But usually GST, if you're an entity located within Australia and you make a sale to an overseas entity, it's usually it usually doesn't include GST. But yeah, with this transaction, I'd probably want to get a bit more information around, like, what's the service, what's happening, where is the entities located, do you have an office over there, where's your staff located? Because there might be a few extra considerations in determining whether there is indeed VAT, which is basically GST for a UK entity. So yeah, we definitely want to get a bit more information, as it's an international tax question, but most chances are it's GST free, but I'd definitely touch base with this post this.
Okay, awesome. The second question is, other than the logbook requirements, what other records should I keep for expenses to deduct?
Great question. So usually we need to keep the tax receipts, the purchase invoices, and the bank transaction. Hence, the accounts payable process is really critical. There's really good third-party software that you can take a photo of the receipts, and it will send it directly into the accounting software. And that should suffice as evidence, along with the bank transaction, as to the deduction. There are some gray expenses, don't get me wrong. Like, if you have certain expenditure might be a lot more harder to determine whether you should, like, what the breakdown should be. As an example, if you have a Coles receipt, some of it might be office expenses, and some of it might be personal. So you'd upload the receipt and you'd have to apportion personal and business. But in general, it's usually, as long as you've got a tax receipt or a purchase invoice, and then the bank transaction, that should suffice as evidence. And your accounting software should save all your historical data. So if you need to find a transaction that the ATO's question, you can jump into your accounting software, search it, locate it, download the receipt or the purchase invoice that you've saved into your accounting software, and then you can get in touch with your bank and get a copy of the transaction and send that to the ATO.
Awesome. The next question is, if I were to engage in bookkeeping services, do I still need an accounting software?
Definitely. Yep. So you're your bookkeeper or accountant. So we offer bookkeeping services, and we'll use an accounting software to do the reconciliations. So you definitely need an accounting software. No, I wouldn't know any bookkeeper that would try to do it in Excel. So yeah, you definitely need an accounting software for your bookkeeping and for your financial statements. And if you have any employees now, you need to do your payroll reporting through an accounting software, usually because of single touch payroll, where you've got to file the pay slips on a weekly or however frequent the pay period is to the ATO.
Awesome, thank you. The next question is, what tax requirements do I have for independent contractors who work for my business but aren't employees?
It's a good question. So I would look at the nature of the contract, and you may have superannuation. So it's really important to determine whether or not they fall within personal services income. If they if the contract is akin to, say, an employee, so you've got a contractor coming in, but they are basically like an employee. They can't delegate the work. You supply some tools and equipment. They're not liable to fix their work. It's likely that you might have some superannuation on that. And if you're in particular industries, there's a taxable payment annual report where you'll lodge on an annual basis to the ATO, or your contractor payments. So you might have paid a contractor multiple payments, and it might equate to, say, 10 grand. At the end of the year, you'll need to report that to the ATO and say, I've paid this contractor this amount for this financial year. And so you'll list out all your contractors. But you only need to do that for specific industries. So if you need to check that, get in touch with us and we can review if one of your industries is within one of the taxable payment annual reporting lists. The key thing is, look, if your business is a bit bigger, you might have to include the contractor payment payments within payroll tax. But I think the key one is really just checking that if superannuation is payable on the contractor payments. That's really key. And also making sure you've got a contract in place with the contractor. Really, really important to make sure there's a contract in place.
Awesome. The next question is, if I wanted to grow my business, what finance options do I have?
Yeah, so usually you've got like your common is debt and equity. So debt is going to a third party sort of a bank or similar. Really hard to get funded for a brand new business. Usually banks want to see trading history. So if you wanted to grow your business, it's going to be hard to go get a loan unless you're securing personal assets. So the most common way people get money in is they sell some equity in their company. So if they're structured as a company, they can sell some shares. As an example, I might have 1,000 shares for myself at $1 each. So if that I put $1,000 in the company, I might say I'm going to raise money. I'm going to put a valuation of $1 million on my business, and I'm going to go out and sell 20%. So I'm going to go raise $200,000, and I'm going to give 200 shares away. So that's the most common way to do that. Obviously, it's if you're getting initial funding, usually it's seed funding, family and friends round, but you need a business plan. You usually might have some sort of financial model that projects what your revenue figures might be and how you're going to get your revenue, what your expenses might look like. You'll have a pitch deck showing, just a summary of the current market, how big it is. So what's the addressable clients within that market. You'll put some key figures. You'll talk about the problems in the market. Why you? Are you differentiating a service or product? So why would people give you money? Some projections maybe, and the team as well. So who's within the business? But yeah, raising capital's not easy, and you've either got debt or equity. If you're brand new business, you're most likely going to have to use equity unless you secure debt against a physical asset like a property that you own, which is a very high risk. If the company fails and you've spent the money, you might have to sell your property. So definitely high risk. Equity, getting some cash off family and friends, getting some traction, and then going to some there's a lot of ways to get equity, but yeah, family and friends round initially, unless you have some good connections to go and pitch to.
Awesome. Just a few more questions before one. Are there any upcoming tax law and accounting standards that I need to be aware of?
Tax law. Yeah, the superannuation rate is changing to 10.5% from July, from 10%. So that's an interesting one. If you've got an accounting software, it automatically will change that. Yeah, there's always changes in the tax landscape. Happens quite regularly. Probably nothing to be too aware of, just understanding when the temporary asset write-off will start and finish, just so you've got an understanding of if you do purchase an asset, will you be able to deduct it in full? GST is not changing. Income tax is dropped to 25% for companies, which is great. Individuals aren't changing too much. So the low to middle income tax offsets changed, which means you'll get a bit more money in your personal tax return. They've increased it. So yes, some minor changes, but nothing too drastic.
Okay, awesome. And just last question, can I claim a home office as a legitimate business expense?
Yeah, so potentially. Yeah, so if you are running your business out of your home, you definitely can, but you do need to have, it depends. So if you're a sole trader, you can just deduct the portion that is an office space against the total floor space. So say you use 1/5 of the house for your business, you could deduct 1/5 of the rent or the mortgage off that. Really important to understand that you lose if it's your own house and you're trying to deduct, say, interest, you lose the principal place of residence portion for the bit you're using as a business. And Yeah, I think definitely get some advice. If you're a company and you want to claim rent that you're paying for personally, you do need an agreement in place, and the rent does need to be at market value. So that's a requirement for claiming rent through, say, a company, that the individual has the lease agreement. So if you've got the lease agreement in the individual name and then you're trying to claim rent through a company, you need an agreement in place between the individual and the company. So yeah, you definitely can. If you're just an employee, obviously you can't claim a portion of occupancy costs. You can only claim running costs. So running costs are things like electricity and gas and lighting and things like that. Occupancy is like your rent payments and rates and interest on loans if you own it. So they're a bit different. If you've got a business, definitely can claim those occupancy costs, but just need to understand how that's going to impact your principal place of residence if you own it. And then separately, are you set up as a company? And if so, you do need that agreement in place between yourself and the company.
Awesome, Pat. We've got one quick question that came in just about a minute ago. This will be our last one. If a family trust is, where is it? If a family trust is distributing funds to a startup company, are there any tax implications for the company prior to it actually making a profit?
Not really. When you say distributing, I'd probably just want to understand what that means. So is it are you loaning the money? Are you buying shares in the company? So is a family trust putting cash in? Is that a loan? Is that equity? Or is it a genuine distribution? Is that company a beneficiary of the trust? And if so, there might be tax implications because it's income. So is it income, or is it a loan, or is it capital via equity? If you're just putting money into a company, there's no tax implications. It's more like a cost base of the shares. So until you sell the shares, there's no real tax change, tax consequence from that. If it's a loan, and the trust puts money into the company, that's fine as well. You can do that. It's when the company transfers money out of the company to a trust, there might be Division 7A, which can create some issues. So yeah, putting money into a company, usually no tax consequences via just, putting some cash into a company.
I think it was a capital investment.
Cool.
You answered the question, which is awesome.
Perfect.
But that's it for today, everyone. Thank you so much for joining our webinar, and thank you so much, Patrick, for taking your time to offer our attendees a lot of knowledge with the end of financial year coming up. We do have a few other webinars coming up. So if you guys did want to join, please have a look at your emails and also our social media pages. But for now, that's it for today. And for those who said yes, our consultants will be in contact. But thank you so much for joining, and we hope you enjoy the rest of your afternoon.
Thanks for joining, everyone. Chat soon.
Thank you. Bye.